All right, welcome to the Explainer. Let's start with a big question. How much money should a bank actually lend to a business? Today, that's a pretty calculated process. But if you rewind to India 50 years ago, it was mostly chaos. Today, we're talking about the committee that came in, wrote the Roguk, and completely changed the game.
You'd think that would be a pretty straightforward question, right? But before the 1970s in India, the answer often had more to do with who you were, not what your business actually needed. And that kind of subjectivity, it was creating a huge problem for the whole economy.
I mean, just try to picture it. You walk into a bank, and whether you get a loan has less to do with your business plan and more to do with your personal connections or what kind of security you can put up. The system was a total mess, right? Inconsistent, kind of unfair, and it was really holding back the businesses that should have been getting funded.
So what did all this lead to? Well, exactly what you'd expect. Big, established companies that already had a ton of assets, they got all the loans. Meanwhile, smaller, maybe more innovative companies were just left out in the cold. It meant that a really vital national resource, all that money in the banks, was being used inefficiently instead of actually fueling real growth.
And this lack of any kind of clear, standard framework, it put pretty much everyone in a real bind. Banks had no objective way to measure risk, and businesses had no transparent path to get the funds they desperately needed to operate and grow.
Okay, so let's get into it. The Reserve Bank of India, the country's central bank, they looked at this whole situation and said, okay, this chaos has got to stop. They knew that for the economy to grow in a healthy, fair way, they needed to standardize how credit was being handed out.
And that's what led them, in July of 1974, to put together a special study group. Their one mission, to finally write that rulebook that Indian banking was crying out for. This group, headed up by P.L. Tandon, had a massive job ahead of them. They had to create a whole new framework from scratch so that banks could figure out what a business truly needed, and just as important, to make sure that money was being used the right way. And out of all their work, the single biggest thing they introduced was this core concept that would literally become the new foundation for corporate lending: maximum permissible bank finance, or as everyone came to know it, MPBF.
Now this right here, this is a total game changer. It's a huge shift in thinking. The committee's main principle was that a business had to have its own skin in the game. Banks were no longer just the default source of cash. They were there to supplement what the business was already putting on the table.
Okay, so how do you actually enforce a big idea like that? Well, the Tandon Committee came up with 3 different ways to calculate this maximum permissible bank finance. And each method, as we'll see, demanded more and more financial discipline from the company asking for the loan. All right, let's break down method 1 with the numbers you see here. So first, the bank calculates what's called the working capital gap, which in this case is 40,000 rupees. Now, here's the new rule. The business has to cover at least 25% of that gap on its own. That's their 10,000 rupee share. The bank can only then lend the other 75%, which comes out to 30,000. And this chart, it really paints the picture, doesn't it? The bank is still putting up the bigger slice of the pie, but now, and this is the crucial part, the business is on the hook for a real chunk of it. Forcing them to have some skin in the game was the first step in this new discipline. Now, method 2. This is where things get a little tougher. The rule gets stricter. Now, that 25% the borrower has to contribute, it's not based on the gap anymore. It's based on their total current assets, the full 50,000. So their required share goes up, which of course means the bank's loan, the MPBF, has to come down. And you can see the shift right there. The borrower's part just jumped from 10,000 to 12,500. And as a result, the bank's loan shrank. You could see what the committee was doing here, right? They were slowly but surely pushing these companies to be stronger on their own 2 feet. And then we get to method 3, which is, you guessed it, the strictest of them all. This one introduces a new idea called core current assets. You can think of this as the absolute bare minimum stuff a company needs: inventory, cash, just to exist day to day. The rule here? The business has to fund 100% of that core stuff itself. And then, on top of that, it still has to chip in 25% of everything else.
So you can see the end result here. With Method 3, the company's own contribution is the highest it's been, and the bank's loan is the lowest. This is the full realization of the committee's big idea. The bank is now truly just a supplement, and the company is being forced to be much more self-sufficient.
So when you put it all side by side like this, the progression is crystal clear. As you go from Method 1 to 3, the borrower's share keeps going up, and the bank's loan keeps going down. But check out that last row, the current ratio. That's a key sign of a company's financial health. With each step, that ratio gets stronger. The committee was literally engineering healthier companies by design.
But, it wasn't just about the math. The Tandon Committee had a much bigger vision. They wanted to build a whole new, healthier ecosystem around lending and borrowing. For example, they said, hey, let's split the finance up. Part of it should be a fixed loan to cover the money a business needs all year round. The other part should be a flexible cash credit line for those ups and downs, like seasonal demand. This gave both the bank and the business a much better handle on things.
And this was absolutely massive. The committee made it mandatory for businesses to send regular, detailed financial info to their banks. Suddenly, banks weren't just lending blind anymore. They could actually see what was going on inside the business and properly supervise the loans they were giving out. Okay, so why does a committee from half a century ago still matter so much today? Well, because its impact was just that profound, and its core ideas are just as relevant now as they were then.
Because 1974 was that pivotal moment. It was the year that the entire compass of Indian banking just shifted. It moved away from a system based on relationships and who you knew to one built on logic, on transparency, and on discipline.
And while specific banking rules have definitely changed over the past 50-plus years, that core Tandon philosophy, that lending has to be based on actual need and that borrowers must have skin in the game, that has absolutely stuck around. It's still a cornerstone of corporate finance today.
And that really leaves us with a big question, doesn't it? In our world today, with fast-growth startups and tons of venture capital flying around, does this kind of old-school focus on financial discipline and solid fundamentals actually matter even more? It's a question that really shows how timeless the Tandon Committee's work truly is.